every missile fired in the Middle East. Someone is cashing in. Most people watch the news and see the fires, the casualties, the diplomatic statements. But the real power players? They're watching something else entirely. They're watching energy markets, capital flows, and a once-in-a-generation opportunity to reshape who controls global wealth. You think this is a war? It's not. It's a resource grab, dressed up in the language of geopolitics. Right now, the Middle East is escalating. The US election cycle is heating up. World leaders are issuing statements, picking sides, condemning attacks. And behind closed doors, every major economy is doing the exact same thing: stockpiling resources, locking in energy supplies, securing their escape routes. Today, we're going to focus on one country that's very far from the Middle East, but reacting more aggressively than almost anyone else: Japan. In just the past few months, Japan has made a series of moves that look almost desperate, dumping $32 billion into the forex market to prop up the yen, burning through its strategic oil reserves at a record pace, paying a premium for American crude it doesn't need to buy, quietly accepting Russian oil it said it would never touch again, and writing a $550 billion check to tie its future to the United States. Why? Because Japan has figured something out. In the post-crisis world, there are no real allies. There's only energy, money, and the raw anxiety of national survival. And here's the darkest part. Behind every Middle East crisis, there may be an invisible transfer of wealth toward America's energy sector. What happens in that region over the next few years will directly affect your gas prices, your electricity bills, your inflation rate, and the purchasing power of your paycheck. If you want to understand how the world actually works, stay with me. Let's start with what Japan has actually been doing. One sentence: Japan is simultaneously fighting a currency war and an energy war. In late April, the Japanese government intervened directly in currency markets. They spent approximately 5 trillion yen, about $32 billion, in a single push to prop up the yen. The goal? Simple: halt the freefall. And it worked. Briefly, the yen bounced back about 3%. But here's the problem. Japan imports almost all of its energy. When the yen weakens, import costs explode. That means inflation spikes, and that crushes the economy. But Japan also can't let the yen get too strong, because they need a competitive exchange rate to keep exports alive. So they're walking a tightrope with no safety net. Intervene too much, exports suffer. Don't intervene. Energy bills spiral out of control. That's the bind Japan is in, and the room to maneuver is shrinking fast. But the currency issue is just the surface. The real vulnerability is energy. Japan has almost no domestic oil or gas. Everything gets shipped in, which means if those supply lines get disrupted, the whole country stops. So on May 1st, Japan made another aggressive move. They released 36 million barrels of crude from their strategic petroleum reserves, distributing them directly to 4 major refiners. Sounds like a lot, right? Except they had already released 80 million barrels back in March, and these latest barrels cost 40% more than the previous batch. As of late April, Japan's total national reserve stands at just 211 days of supply. They're spending faster than they're replenishing. The cupboard is getting bare. So Japan did something that would have been politically unthinkable just a few years ago. They went to 2 countries they'd been trying to distance themselves from. First, the United States. After Middle East tensions escalated in late April, the first tanker loaded with American crude docked in Tokyo Bay. Japan's plan: quadruple its imports of U.S. oil by 2025 and 2026. Here's the catch. American crude shipped to Japan has to travel through the Panama Canal. That means smaller tankers. And the shipping cost is more than 3 times the Middle East route. This is not a business decision. This is a political purchase. Second, Russia. Yes, Russia. In early May, Japan quietly accepted its first Russian crude shipment since the Ukraine war began. It came through the Sakhalin-2 project. Japan has a sanctions exemption, but this is still deeply uncomfortable territory for Tokyo. What does it tell you? It tells you Japan has reached the point where energy security trumps political optics. Survival beats ideology. But here's the problem. The American oil is too expensive. The Russian oil is too politically sensitive. And neither one solves the underlying problem. Japan knew it needed to make a much bigger bet. So Japan decided to go all in. They committed to investing $550 billion in the United States. Let that sink in. $550 billion. That's roughly 10% of Japan's entire GDP. And the money isn't spread around randomly. It's surgically targeted at America's most strategic sectors: semiconductors, AI, quantum computing, critical minerals, and above all, energy infrastructure. The first tranche, $36 billion, landed in February. It went toward a gas-fired power plant in Ohio and crude oil export facilities in Texas. Then in March, an additional $73 billion energy-specific deal was signed. Japan is helping fund American LNG terminals and oil export systems. They're financing 10 small modular nuclear reactors on U.S. soil. They're even contributing to upgrades of the American power grid. Now, you might be thinking, isn't this just normal foreign investment? No. Here's where it gets jaw-dropping. Japan has almost no decision-making authority over any of these projects. America runs them. And the profit split? Until Japan recoups its investment. 55-45. After that, America takes 90%. Japan gets 10%. Read that again. 90% to America, 10% to Japan. No rational investor signs that deal. Unless it's not really an investment. It's a protection fee. Japan is essentially writing a $550 billion check and saying, our energy supply, our national security, our economic future, we're putting it all in your hands. This is why America can project such overwhelming force in the Middle East right now. It doesn't need to fear an energy crisis anymore. Most people's mental image of America and oil is stuck in the 1970s. Long lines at gas stations, rationing, panic. That world is gone. Today's America doesn't fear Middle East chaos. In some ways, it benefits from it. Here's the data. In 2025, the U.S. produces roughly 13.6 million barrels of oil per day. That's about 17% of global supply. 70% of that comes from shale, and shale production is profitable at around $65 a barrel. In just over a decade, the United States went from the world's largest energy importer to its most dominant energy exporter. Natural gas tells an even more dramatic story. U.S. production has grown 60% in the past decade. By 2024, America accounted for more than a quarter of global natural gas output. When Russia cut off gas to Europe after invading Ukraine, the U.S. stepped in. America is now the world's largest exporter of liquefied natural gas. But here's the twist. America produces so much energy domestically, prices at home have collapsed. In 2024, U.S. natural gas spot prices hit $2.21 per million BTU. In some regions, 12 cents. 12 cents. Basically free. So, how do you make money when your product costs almost nothing at home? You sell it abroad, at a massive markup. And the best way to drive up the price abroad? Keep global supply tight. Keep the Middle East unstable. Every escalation, every airstrike, every shipping disruption, it adds what traders call a war premium to global oil prices. Europe panics. Asia panics. They pay whatever it takes to lock in supply. and American LNG ships sail out fully loaded at premium rates. Japan's $550 billion investment just happens to build out the entire export infrastructure that makes this machine run. America isn't just selling oil, it's selling fear. It's selling security. In this game, America is the house, Japan is a paying customer, and the Middle East is the volatility engine that keeps prices elevated. But don't mistake the Middle East for a passive victim here. The countries in the region know exactly what they're sitting on, and they're moving fast to cash in. The clearest example, the UAE. On May 1st, the UAE announced it was withdrawing from OPEC and OPEC Plus, ending nearly 60 years of membership. Why? Because OPEC's production quotas cap the UAE at around 3 million barrels per day. But the UAE has spent $150 billion expanding its production capacity to nearly 4.85 million barrels per day. That means 40% of their capacity is being artificially throttled by the very cartel they belong to. With oil prices elevated and the region in turmoil, the UAE looked at the situation and made a simple calculation. This is a money window. Open it all the way. But the UAE didn't just boost production. They future-proofed their operation. The old vulnerability of Middle Eastern oil was always the Strait of Hormuz. That narrow choke point, if blocked, could detonate global oil prices overnight, so the UAE built around it. The Fujairah pipeline now bypasses the strait entirely. Capacity, 1.5 million barrels per day. Port export capacity, up 50%. Saudi Arabia is building similar bypass routes. Japan, meanwhile, has already rerouted 20% of its oil imports away from the strait and is targeting 60% by May. They're even sourcing crude from Azerbaijan now. Smart hedging across the board. But here's the brutal irony. The more successful you are at profiting from instability, the more you become a target. On May 4th, the Fujairah Oil Industrial Zone, the UAE's critical bypass hub, was hit by a coordinated drone and missile attack. UAE air defenses intercepted 12 ballistic missiles, 3 cruise missiles, and 4 drones. Someone sent a message. If you're getting rich off this war, you're not neutral. Which means the Middle East isn't moving toward stability. It's moving toward a more complex, more dangerous cycle, where the more money flows, the more targets appear. So where does this leave everyone else? Are smaller countries just supposed to pay protection fees like Japan? Buy expensive oil and hope the supply lines hold? Actually, the smartest players figured out a completely different answer a long time ago. Because the best solution to energy insecurity isn't securing more energy. It's making fossil fuel energy irrelevant. Here's the most ironic case study in this entire story. Japan, which we've just watched surrender its energy future to the United States for 90 cents on every dollar, has been making the exact opposite bet in a completely different industry. At the Beijing Auto Show in late April, Nissan announced that China would become its core R&D hub going forward. By 2030, Nissan plans to sell 1 million EVs in China annually and export Chinese-built electric vehicles to markets across Latin America and Southeast Asia. Mazda announced the same play. Build in China, sell globally. Think about what this reveals. Japan is simultaneously pouring money into American oil and gas infrastructure, essentially betting that fossil fuels will dominate for decades, and quietly leveraging China's electric vehicle supply chain to hedge its automotive future. Because at some level, Japan's leadership knows the truth. The only real escape from the energy trap isn't a better pipeline, it's a better technology. That's the most important line in this entire video. When someone forces you into a resource war, the amateur move is to fight harder for the resources. The expert move is to walk away from the table and make the table irrelevant. The Middle East will keep burning for a while. Wall Street will keep engineering volatility to extract maximum value from the chaos. But the countries that actually win the next 50 years won't be the ones who controlled the most oil fields. They'll be the ones who built the strongest technology stacks, manufacturing bases, and supply chains. When a storm hits, some people pray it passes. Others build wind turbines. That's it for today. If you want more breakdowns of the systems and incentives that actually run this world, subscribe and leave me a comment. How long do you think American energy dominance can last? See you next time.